Curt Long, Head of Emerging Issues and Deputy Chief Economist for America's Credit Unions. In this month's Economic Update video, I'll show you our initial forecast of 2025. We're in a new year with a new Congress and a new administration. We've also had some important economic developments since our last forecast, resulting in important revisions to our 2025 outlook. In our previous forecast, we emphasized that after a period of high inflation and rising interest rates, the economy was returning to normal. Broadly speaking, we still believe that. Our forecast for real GDP growth in 2025 is 2.3%. That lines up identically with the most recent estimate for potential GDP growth from the Congressional Budget Office. An economy growing in line with its potential should deliver low unemployment without elevated price pressures. There's plenty of uncertainty in that assessment, but we do think the stage is set for solid growth, a healthy labor market, and low inflation. Speaking of uncertainty, our forecast group spent a lot of time discussing the ways that our forecast could miss the mark. And topping our list for 2025 were political risks. Which policies from the campaign trail President Trump chooses to prioritize, and the precise details of those policies could have a major impact on labor supply, inflation, and deficit spending. But we do believe that the economy enters the year in a healthy condition. One aspect of the economy that improved last year was the labor market. During the 12 months ending last July, the unemployment rate rose from 3.5% to 4.2%. Historically speaking, that's a large increase, which had a few of our economists worried that the labor market could be on shaky footing. But that troubling trend stabilized in the second half of 2024, and unemployment actually finished the year a tick lower at 4.1%. There are still pockets of concern, but evidence suggests that risks to the labor market have receded in recent months, and we expect no change to the unemployment rate in 2025. Another measure that stabilized during the second half of last year was inflation. Unfortunately, it stabilized at a level that is still somewhat higher than the Federal Reserve's target. But we do expect to see inflation gradually subside in 2025, consistent with the moderate cooling we expect in GDP growth. The stubbornness of inflation we saw in late 2024 caused the most dramatic change in our forecast versus the one we did last October. At that time, we were expecting the Federal Reserve to cut rates by a full percentage point this year. But given that we now expect it will take all year before inflation nears the Fed's target, we reduced our forecast to just a single quarter-point cut in 2025. We also expect the 10-year Treasury rate to trend sideways this year. We see two offsetting factors at work. On the one hand, there should be some amount of downward pressure on long-term rates as inflation subsides. However, we also expect that government deficits will remain large in 2025. That will require more Treasury issuance, which should keep rates elevated. Let's turn now to the credit union forecast. While our economic outlook is generally positive, our industry outlook is a little more mixed. On the plus side, we're seeing stronger growth in savings, and we expect that to continue in 2025. Our forecast for this year is for 6.5% share growth, which is very close to the long-run average. However, we still expect that growth to occur mostly where it's been lately, in share certificates. That means credit unions will continue to see stresses around cost of funds. With rates staying near present levels, we downgraded our forecast for loan growth in 2025. As most of you can attest, the housing market is a lot like winter weather, frozen. Sales of existing homes remain stuck at exceptionally low levels. While sales of new homes have picked up some of the slack, the impact of higher interest rates is hurting construction activity. Until we see a better interest rate environment, we expect the very low demand for mortgages to persist and only minimal improvement in auto loan demand. Our forecast for ROA in 2025 is 0.75%. That is below the long-run average, but should nevertheless provide enough fuel for credit unions to grow net worth faster than assets. Our forecast calls for the credit union net worth ratio to reach 11.2% by year end, which is in line with the pre-COVID level. Finally, I'll end on a positive note. One of the biggest challenges for credit unions recently is credit quality. We've seen a sharp rise in both delinquencies and net charge-offs over the past 2 years. The good news is that we think we're at a turning point. Our forecast for both metrics is for a modest decline in 2025. Credit unions are historically prudent lenders, and we expect those measures to return to pre-COVID levels, but it will take some time. That'll do it for this month's Economic Update video. You can find our complete forecast using the link in the video description. Thanks for watching, and we'll see you next month.